Hello and welcome back to the beach. Today what we're doing is we're talking about discounted cash flows. Now discounted cash flows will be shortened down to a thing that we call DCF. So DCF is the shorthand version of discounted cash flows. You may also see DCFs talked about when we start harping on about NPVs, net present values. Now net present values are very closely linked to DCFs, so you do need to make sure that you're happy with DCFs before you can use NPVs. NPVs are a key way that we can potentially try to make investment decisions. And what we do here is we look at future cash flows and we try to work out what the current value of a future cash flow will actually be. So we look at what the current value of a future cash flow will be, and then we add them all up and see whether it comes out as being a figure which is positive or negative. If it's a positive, then we invest. So there's my investment decision. Discounted cash flows can also be used as a way of determining the value of future cash flows that a clutch of assets can potentially generate. So we can use it as a valuation of assets principle. And we can also look at the amount of cash flows that a business can potentially generate, which means that we can look at it as a valuation of businesses as well. So we can value a business, even if this thing is not quoted on a stock market, we can value this business based on the future cash flows that it is going to potentially create. Okay, so what's this all about then, Ed? Well, this is all about the idea that cash now has got more value to me than cash in the future. And what this basically means is a similar amount of cash, $100 now, is worth more to me than $100 in 1 year's time. This comes about because the $100 now can be invested to generate a return in excess of $100 in 1 year's time. So how much is that $100 in a year's time going to be worth? That's the core question. And that's what this short session is all about, trying to find out. Now, to start with, I need to talk to you about simple and compound interest. And we'll look at this and then we're going to pull it right back in to try to determine exactly how much a future cash flow is going to be worth. Now, you can have simple interest. Simple interest is when interest is paid every single year. And what that now means is if we had $100 on deposit and we had an interest rate of 10%, that now means that we would get $10 per annum every single year. So we would get $10 per annum every single year. Well, that's not a very good way to run a bank, to be honest with you guys, because what actually happens in the real world is we have a compounding effect. And what this means is we have a $100 deposit, which we place on our deposit today at a rate of 10%. That 10% generates $10 worth of interest in year one. That now means that at the end of year one, I've got my original $100 plus an extra $10, which means I've now got $110. That $110 now generates an interest amount in the second year of 10% multiplied by the 110 gives me $11 in year two. That now means that I've got at the end of year two $100 plus $10 interest from the first year plus $11 interest from the second year. That gives me $121, which means that in year three we get $12.10 worth of interest. So that now shows you how the amount of interest I get every year increases slightly because the interest I've already received gets an element of interest as well. We call that the compounding effect. So we call that the compounding effect. And we can actually put that together into a formula, and that formula is as follows. We have got the future value of the cash flow, in this situation, how much money I'm going to have in my bank account in a certain number of years' time, equals the amount of money we place on deposit now, which is my principal, multiplied by 1 plus the rate of interest. So if I had 10%, I'd have to show that as 0.1, all to the power of n, which is the number of periods. Now, what I would suggest you do here, guys, is pause the little recording here to make sure you're happy with it. Whip your calculator out and say, if I had $100 and I'm now going to invest that for 3 years at a rate of 10%, that now means that I will get an amount which will be 100 plus the 10 plus the 11 plus the 1210. So that now gives me a total of 133.10. So make sure that your number crunching shows you that that's actually what happens. Once you're happy with that, Do it for 4 years, because what I can now do is I can say that in 4 years' time, the amount of money I'm going to have will be the $100 I invest plus an extra amount of interest over the 4-year period, which does not equal $40. The extra interest I get because the compounding effect will be 46, 41. Oh, wow, that's actually quite cool the way that works. Banks and every financial institution in the world know how this works, and they always take it into account. And what this now means is, if I have a scenario whereby the rate of return on this interest or this risk-free return that I have is 10%, that now means that as a rational investor, so somebody who understands risk and return, I would be indifferent between $100 today or $146.41 in 4 years' time. Oh, hang on a minute. That now means that the future value of 146.41 has got a discounted cash flow, a present value of $100. And what we do to find out the present value of these future cash flows is we effectively reverse this. So we will reverse the compounding effect. So we're going to reverse the compounding effect. And what we do is we take the amount of money we're going to receive in the future, which is my 146.41, and then we multiply it by 1 over 1 plus r to the power of n. Oh, hang on a minute. Another way of showing this, would be to take the 146.41 and then multiply it by 1 plus 10%, which is 0.1, all to the power of minus 4. So that minus 4 just says it's 1 over that, which means we're going to divide it. Try that in your calculator. Put it in the brackets, put it to the power of minus 4, see what number you get. Then multiply it by 146.41. You should now get $100. Happy days. Now that 1 plus 10% to the power of minus 4, which is 1 over 1 plus 10% to the power of 4, is known as the discount factor. And you may find that if you are doing some sort of calculations here, you will be given discount tables. These discount tables give you the discounting effect. However, it's always rounded to 3 decimal places, which means that there's always going to be some sort of rounding errors. So there's always some sort of rounding errors. Now, the wonderful thing about this is if we now know what the discount rate is, and we'll have an extra session to tell you what the discount rate should be. So if we now know what the discount rate should be, that now means that we can look at future cash flows, discount them back to give me a present value, and I can now make my investment decision. So do I think this is a good investment or not? If I think it's a good investment, boom, right, let's do it. Happy days. That now gives me a good investment decision. Do I think I should invest in this business? I can work out what the present value of all the future cash flows will be valued at today. That is the maximum amount I should be prepared to pay for that business. So there's my business valuation model as well. Absolutely fabulous. So this means we can calculate the value of any type of future cash flow. So this means I can calculate the value of any future cash flow. We then add them all together to get the total present value of those future cash flows, then look at how much it will cost me to invest into this project or this business, and that gives me a net present value, the NPV. And that brings us all the way back to the very beginning when I said NPVs and DCFs are very closely linked together. Now, hopefully that's made an element of sense to you, please, boys and girls. I do hope that you do understand exactly what's going on here. If you're not quite sure, go back into our online system and have a little look at some more examples just to make sure you are happy with it. This is absolutely critical in the financial world. This is the type of thing that everybody does all the time. Thanks ever so much for your time and attention, boys and girls, and I'll see you back on the beach very soon.